All righty, so off we go. From brunch to buy-in, because friends don't let friends rent forever. Okay, let me see if I can get this. Aha! Just click on the screen. My name is Tia Honeycutt, and I am the broker founder of Proxima Realty Group. We are a brokerage here in the San Francisco Bay Area. So please do bear in mind that a lot of this advice is specific to the rules and practices of the area. If you're out of area, please do refer to a local realtor who can let you know whether or not the information that I'm giving you is applicable to your area. So, what are we going to talk about today? We are going to talk about buying property together. As the prices start to escalate, it becomes more and more difficult for one individual or a couple to be able to break into home ownership. And so, there are some strategies and procedures that you can put forward so that you can buy as a group, either with friends or coworkers or even family members. Oftentimes, friends and coworkers are better than family members because people tend to be more organized going into those relationships and have more respect for each other sometimes. So we want to make sure that you have some structures that you can put in place, and perhaps even if you did want to do it with family members, some things that you can agree upon ahead of time to make sure that that relationship continues to be a positive one. So we're going to look at how to structure ownership, financing options, what might must be in your co-ownership agreement, how to avoid conflicts, and real examples, some real concrete examples of folks that have done this work. Again, disclaimers. My name is Tia Honeycutt. I am a broker in California, so a lot of this information is relevant to the San Francisco Bay Area. A lot of it will be relevant nationwide, but there are perhaps some specifics, certain programs and things like that that may or may not be available in your area. So you'll really want to double down and do some research with your own local realtor to be able to figure out if there are programs available to you to be able to assist with this. And I bet there are, but they're usually state and local specific. So you want to check those out. Also, as a realtor, my expertise is preparing you for home ownership, assisting you once you are a homeowner, with my volunteership at the state, local, and national level, advocating for home ownership rights, and making sure there continues to be an environment where folks can begin to be homeowners and continue to do so. But I am neither an accountant or an attorney. So the information that I have for you is preliminary, purposefully, because I am neither of those professions, and it is actually against the law to claim to practice law unless you have a license to do so. So I'm going to give you some generalities, and then as far as specifics are concerned, you're going to actually want to consult an accountant and consult an attorney when the time comes. All right, so co-buying with friends. So why? Why would we take this on, right? Well, very simple. Because down payment, mortgage, upkeep, all of these things are costly, but also are take a lot of time, right? When you're coming from being a renter to being an owner, one of the biggest transitions that I notice folks tend to maybe have underestimated is the fact that there are a lot of things that a landlord takes care of on your behalf. They also take all of your money on a monthly basis and in return only give you a place to stay. But there's a lot of things that they're taking care of. So, something breaks, you call the landlord. Something overflows, you call the landlord. When you're a homeowner, that becomes your responsibility, right? So it's nice to be able to split that up with other folks. And sometimes when things like that happen and you have friends, you start to realize that people have all kinds of skills that you didn't realize they had, right? That their dad showed them how to plumb them, or their mom showed them how to, hammer in floorboards, or there's some sort of skill that folks didn't realize that everyone has, and you're going to kind of crowdsource any of those issues that come about. Of course, the pooling of assets, meaning, if you have something that happens, it's nice to be able to say, hey, can we all throw in the pot? Because then it makes it so that it's less expensive for everyone. And then, of course, if you're teaming up, then you don't have to wait as long to try to save up for a down payment. One of the things that's so hard now about the fact that the average first-time home buyer is 38 as opposed to 28 just 10 years ago is that that's 10 years of rent that's being paid out that could have been saved or put towards building equity in a property, meaning instead of paying rent all of those years, folks could have been paying into their own mortgage, which is almost they call it a forced savings program, but you really are saving for your future, right? And at the end of the time, when you decide, okay, maybe I want to buy another place, you have a situation where you have all of this equity, all this value stored up in the property that you can then either tap on to buy a new place or you can sell it and split the assets. So that's what's meant by equity is all of this earned value that you have stored up in a property over time. And if you are able to pay 10 years of mortgage as opposed to 10 years of rent, you've really put yourself ahead of the game. So these are the reasons why. Let's see. Um, oh, Let's see if we have gone. Oh, there we go. All right, so pick the right team, right? As I said, I've seen a lot of success with friends and coworkers because a lot of friends and coworkers who want to be around each other pick each other, right? So usually if you are already in a friend group, there's a certain amount of respect that you have for a compatibility, you communicate well. Those are all things that are going to give you success as you move into your home ownership journey. Now, what we're going to want to do as we're moving into this process is make sure we're all on the same page about the use of the property, right? Is it going to be a place where we're all going to live together? Is it going to be something that we are going to rent out and take the value out of together? Or is it going to be a place, a vacation home that maybe we'll be there together and maybe we won't, and we'll kind of use it that way. And then additionally, when neither of you are there, maybe you Airbnb it, right? So there's a lot of options that start to open up for you when you're creative about approaching property ownership. I am also noticing a lot of folks that are, particularly in the San Francisco area, buying property out of state, using it as an investment, letting that equity build up, using it as a second revenue stream. And then once that assists them with their efforts to save, and then that puts them in a position to be able to buy a property in the San Francisco Bay Area. So this is something that is absolutely being put to work with folks. Now, another thing you're going to want to talk about ahead of time is how long will each person stay? Doesn't have to be set in stone, doesn't have to be agreed upon ahead of time, but at least if you go into the conversation understanding that, one person intends to be there forever, other party is like, well, maybe it'll work for now. Another party is like, I don't know. At least you have some sort of a starting point because that's going to inform the type of property that you look at, perhaps. Exit strategy. Again, if you look at how long everyone is going to be in the property, you can at least start to talk about it. Things do change. Most people say I'm only going to be in place 3 years, then 5 years rolls around, then 7 years rolls around, and then there's a life change. So it's usually a life change that dictates how long you're in a property as opposed to, a grand plan ahead of time. But it is still nice to talk about these, important to talk about these things with each other so that you can start to discuss, okay, well, if you're thinking of leaving here, maybe then we would hold on to it, or maybe we would sell it. You can just be very creative in the process, and really more than anything, get in the habit of discussing these things, and get that comfort level of discussing them. All right, so now we're going to get into the nitty-gritty. Legal ownership, legal structures and ownership. So we're going to talk about tenants in common versus joint tenancy. We're going to talk about LLCs versus trusts and we're going to talk about a co-ownership agreement. Now, what is tenants in common? versus joint tenancy. These are actual ownership structures. So you may or may not know when you own a property, you have to hold title, mean hold ownership. The legal concept of how we connect ourselves to the property as the owner of the property is called a how you hold title, right? And so when you are purchasing as a group, and let's say you're not married to each other, right? Which in California would be common law. Uh, uh, well, there's another concept that we're not talking about right now. But anyway, there is a way that you hold title by yourself, right? Which is sole and separate. And it can also be that you hold it in common with your spouse or common law spouse, right? Which is someone that you have been with for 7 years or more. That's a really interesting concept that we have here in California. I don't know that we have elsewhere. Community property. That's what it's called. It's called community property when you're married or you have a common law spouse. And then what we're talking about here, because we're not talking about necessarily a couple, and you find this too in our LGBT community, that they hold property in this way as well, especially before marriage was legal. You used either tenants in common or joint tenancy to make sure that folks' ownership in the property was protected, even though they were not married. So there's two ways of looking at it. Tenants in common are two directions you can go with it. Tenants in common is where each person owns a specific share, which doesn't necessarily have to be equal. It doesn't have to be 50-50, but can be. It depends on how many people are part of your group. It can be transferred or sold without the other's consent, and there's no right of survivorship. Meaning, right of survivorship means your heirs inherit your property, but with tenants in common, that's not the case, right? With joint tenancy, all co-owners hold equal shares. This means they includes right of survivorship, which means you can pass it, right, to your heirs. And it's harder to change the tenancy without breaking the joint tenancy. So again, let me be clear. Um, these different ownership structures, I said earlier, I'm not an accountant, I'm not an attorney, and I'm also not an escrow or title officer. So what I'm seeing with both of these is that you're going to want to double check with escrow and see which of these benefits you best, depending on what you want to do with the property, right? Do you want to have it be a situation where people can sell their shares without um, the approval of the other owners? Do you want it that if they something happens to them, that it automatically passes to the group, or that it automatically passes to their heirs? Again, one thing to bear in mind is when you buy the property, it may be easier to buy it in one way, right? And then transfer it after. Should there be any changes in the group or in the way that your agreement with each other, right? If you research it and you're like, well, actually, I think we want to do this a little bit differently, you absolutely can. It's just like when folks have owned property as community property, and then maybe through divorce or maybe just an agreement, they decide, well, actually, I want this property to be my sole and separate, and we'll keep the other property as community property. That can happen as well. Now, there may also be tax implications, and I am definitely straying into escrow's territory here. So I do want you to research each of these so that you can have a sense of which makes sense for you. All right, I think that's enough about. All right. This is a little bit different, right? So when we're talking about um, the way that you hold title as far as whether you hold it as an LLC or a trust, this is another legal protection for you that will help more in the terms of being sued, right? So I'm looking at lawsuits here, especially if you have rental properties. I actually suggest owning both in both of these ways. right? So what with an LLC, you would basically create a legal vehicle, right? And it actually shields your personal assets from lawsuits. The great thing about this for a group like this is that the more of you that there are, the more protected you are, basically, right? So basically, you create this organization. It's a legal construct. It shields personal assets from lawsuits. It's the ownership is divided into membership shares. The operating agreement covers rules, contributions, and exits. There's pass-through taxation or corporate election, and it's really best for friends that are co-investing in rental or income properties, or actually in a property that you're living in as well. So that's an important aspect of LLCs that we might want to think about. All right. Now, a trust is similar to an LLC, but it really is great for families, right? Because what it does is it holds the property on behalf of the beneficiary. So you have to, once you create the trust, you have to fund the trust, which means you have to re-record the property in the name of the trust, right? So it kind of sits in this legal structure. The trustee manages the property according to trust terms. It does not necessarily protect the property owners from lawsuits. It's really much more about protecting your ownership of the property than the lawsuit aspect. Income usually reported on the beneficiary's personal tax returns, and it's best for families or groups focused on inheritance and legacy planning. So usually I recommend a trust for folks that are, have children, are family members, and want to have agreement amongst each other. And then often, sometimes, people will also create an LLC as well, but particularly for investment property. The interesting thing that I've seen with LLCs as well is that some people will create an LLC per property. So per income property, they'll have a different LLC. And the protection that you get from that, of course, is if there is an issue with a particular property, it's kind of siphoned off from all of your other assets. So there's some really interesting tricks of the trade that we can use as far as the way you hold property and the way that you hold title. So there's a great opportunity here for some research to see which works best amongst you all. An ownership agreement. All right, so we're really meeting the road on this. All right, so as we spoke, as I mentioned before, there's a percentage of ownership shares that you may want to discuss prior to ownership, especially when you have a situation when you're all sharing a single family property, meaning like a house, right, or a condo, right, where everybody has a room, but they don't necessarily have their own particular domicile. Right. Now, if there's two parties and you have a duplex, that makes it easy. If there's three parties and it's threeplex, that makes it easy as well. But in particular, when you have a situation where everyone's kind of sharing a property in common, you're really going to want to look at the ownership shares, and you can look at a few different aspects, right? You can look at how much people are contributing to the down payment, but you can also look at how much people are going to contribute to the mortgage, how much of the repair onus is going to fall on particular individuals. And you may wish to kind of move those balances around depending on, well, someone might be bringing all the down payment, but someone else might be paying three-quarters of the mortgage and also might be taking on all the repairs. Maybe not the cost of all the repairs, but someone is saying, yes, I will do all the repairs. Well, that's of value, right? So maybe then that shifts the balance of ownership percentage as well. That's a lot to take on. So I would definitely think very closely about that because usually maintenance for a property includes landscaping, it includes plumbing, which is usually the first thing that goes because it's used the most regularly. The upkeep of the property, this especially becomes difficult when you don't live on the property and if the property is in another state or another area where you have to drive there and do these stuff. So it's definitely a consideration, and I'm not saying that to try to dissuade you from doing it. I'm just saying make sure you don't undervalue your labor because the labor is something that's going to continue over the ownership of the property, whereas the down payment, that'll be paid and that's it. So some interesting things to consider there. Financial responsibilities. Remember, in addition to your mortgage, unless it is as a part of your mortgage, which sometimes they do, you're also going to have property tax. And so when you purchase a property, they will sometimes create another escrow account and they will hold those taxes for you and they will send the payment on your behalf, right? So sometimes those charges are taken care of. And when you purchase the property, usually you pay the year up front as far as your insurance. We call it burn down insurance is concerned. But then in the following years, that's going to be on you, right? So make sure you're bearing in mind that you have mortgage expenses, you have property tax, you have insurance, and then of course you have utilities, right? Who's going to keep the lights on, right? And the water and the garbage. So make sure that you are looking at these expenses in total so you can really split them up against each other, amongst each other equitably or in a way that makes sense based on your percentages that you already determined. One thing that's really important to do as well is to make sure you have a reserve because you may have months and months where nothing is going on and then all of a sudden you've got a big thing, right? So in a sense, you want to create something like a little HOA where there's a little bucket. Maybe it's a couple $100s a month, whatever the amount might be, so that when the big expense hits, all you have to do is pull out of that account or out of that fund. And it might be a good idea even to set up a bank account for that purpose. All right, property use and rights. Again, make sure you're clear about who's going to be living there and who's going to be living where. This becomes, again, particularly important if you are all in the same living space, where maybe someone has a bedroom and someone else has, part of a bedroom. Who's going to be in the kitchen when, who's going to be in the living room when, who's going to be in the backyard when, right? You have to be very organized about it so that people are actually able to use the space in the sense that they thought they were going to be able to. Um, Easier for property that you're not living in, of course, or where you have your own separate, again, living area. But if you have a situation where you have, for example, a vacation house, are you going to hire a third party to run the, Airbnb? And if so, who is paying for that? To what extent? Are there times when the owners get to use the property? What is the agreement around that? Just some things to think about ahead of time to be able to make sure that there are no hard feelings, right? So when it comes to decision making, sometimes the smallest things can lead to lingering resentment. So we don't want to find ourselves there, right? Everything from paint colors to selling or refinancing the property, right? How are these decisions going to be made? Is it going to be majority rules? Is it going to be some other method of conflict resolution, right? So knowing that ahead of time and being able to work that through one's mind emotionally really helps in terms of not having any lingering resentments. And that's what we want to make sure that we don't have. Exit strategy should be discussed ahead of time, even if it's a situation that something changes or an event occurs, which kind of makes it so that everyone decides that they want to do something differently. But it's good to talk about it ahead of time, and it's good to talk about how it's going to be worked through. So, buyout terms, process for selling, rights of first refusal for remaining owners. All of that should be discussed. Dispute resolution. Usually we use mediation and arbitration in these disputes in real estate, and the reason is because there are a lot of them, and they're usually can very much be resolved through a situation where you have a skilled mediator helping you all come to terms, right? And it's usually just a misunderstanding or an inability to take in all of the possibilities, right? So I would say first and foremost, start with your realtor because realtors are used to solving um, uh, not disagreements, but misunderstandings and letting folks know what is possible, right? I feel like a lot of what a job is as a realtor is sharing with people what is possible. So start with your realtor, and then, of course, skilled mediators can very much help you as well. All right. Let's see here. Financing and money mechanics. All right. So, when you have a situation where you're buying a property together, in general, and again, I'm not a lender either, but these are some generalities. Um, it seems to be a little bit easier when you have a group that goes in for getting your mortgage as opposed to one person necessarily being on the loan by themselves. And it's just because there's a joint effort as far as that's concerned and joint responsibility, right? Now, that's not to say that one person couldn't go in and do the purchase, right? But you may want to do some work after just to make sure that, whether it's like putting someone on the loan or maybe you don't want them on the loan because you're like, no, at least I know if I'm on the loan, I will make the payments and then I can, pursue other means if the other rest of the payment isn't coming in. So that's something to discuss as a group, but I just wanted to say generally it is possible to get a loan as a group. So that may be something that you want to consider. The shared bank account for expenses is what I mentioned earlier, right? You might want to create like a little HOA account where folks make deposits and on a monthly basis. And then it's there for you when something happens. Now, the better condition the property is in, the less need you'll have for that account. And by the time you do draw on it, it'll be quite large, right? Usually, again, the things that I tend to see go first are plumbing, either from improper drainage, so you want to put in a French drain, which is a larger expense, to the smaller things like a leak under the sink, a leak under the toilet, the hot water heater, if it were old, kind of gives out. The furnace, if it's old, gives out. Other than that, there's not too much if the property was in pretty good condition when you bought it. If you bought a fixer, then you're going to want to go in and address those things so that you don't have these big expenses down the road. So sometimes it's easier to get a credit from the seller or ask the seller for those repairs so that you're not, moving into your property, dealing with all your moving expenses and purchase expenses. And then now you got some other big project that you have to undertake because the property is not in great condition. And then, of course, you want to have transparency as far as contribution and payments, right? Again, discussing who's going to pay what, who's going to be responsible for sending in the payment, where does the payment go? That could be a little tricky too, because if you have not owned property before, you are not aware of all the machinations that occur on the back end as far as loans are concerned. And the fact that oftentimes the person that you got the loan from is not going to be the one that's going to be accepting your payments. That's called your servicer. And oftentimes, immediately after you purchase the property, the servicer changes, or doesn't change, it's sold to someone to service on your behalf. And then sometimes while you continue to make those payments, they're sold again. Right. So sometimes it takes a little while. That's why they have you pay your first payment out of escrow because there could be a period of time before it is determined who is going to service your loan. And in the meanwhile, they don't want you missing a payment, right? We would love to, but they don't want you missing a payment. So they usually take that up front. So again, who are we paying and how much are we paying? Where does the payment go? When's the payment due? It's due on the first, but they give you a grace period, sometimes 5 days, sometimes 10 days, depends on your servicer. So you'll just want to have that conversation. Um, as you go through the process, and then after the process, make sure someone is keeping an eye on that. All right, so risks and mitigation. Again, we've talked about this a little bit. Most important thing is about the line, opening the line of communication, right? So, what happens when there's a determination as far as how much someone is supposed to be paying, but they miss a payment, or they're looking at this thing and they're saying, well, actually, I'm doing a ton more work than I thought I was. I want to renegotiate my contribution amount. Most important thing is to talk about it, right? And try to see if there's something that can be done, right? So everybody falls into times where their cash flow is greater or lesser. And so we want to make sure that we can have a conversation around how we're going to address those situations. Are we going to dip into our reserves to cover in case someone has a situation that arises? Or is it just going to be a quote unquote gentlemanly agreement amongst ourselves? All those things are opportunities to discuss around those issues. And then also you'll want to like have your own kind of backup plan around what happens if we do miss a payment. What I can tell you as far as the lender is concerned is you do have about, let's say, 29 days of where you can still get that payment in and not have credit or other implications, right? And in my state of California, you're not kind of getting into the red zone until you get into those three missed payments. Of course, you don't want to miss three payments, but what I'm saying is it's not going to be imminent as far as foreclosure if you miss a payment. What's much better to do is week one hits, week two hits, you're like, uh-oh, I thought I was going to have it, but it's not showing up by the 15th. You're much better off to call, well, first of all, discuss amongst yourselves, and then immediately call your lender and let them know that there's an issue that's arising and see if there's some other way that you can address it. Sometimes they can put a payment on the end. Usually that's if you're in much worse shape than just having missed a payment. But also reach out to your realtor. Because I have strategies and most realtors have strategies to be able to see if we can help out in a situation that it's a mispayment and see if we can come up with some strategies around that. All right, so I'm going to show you a couple of different real life strategies so you can see how these worked in real time. Three Gen Z friends in Tampa, Cobot, all are under 25. What they did was they decided to form an LLC and put different shares into the down payment. One of them actually lives in the property while the others are renting. So that's an interesting, it's an interesting way of going about it. I guess the thought there was they were happy where they were, and so they figure, well, why not own a property together? And I'm assuming, of course, that the one who lives there has a larger share as far as what they're paying towards the property, or the property goes towards their payment goes towards the mortgage. So that's an interesting scenario because I've never seen a situation where either everyone wasn't living there or no one was living there. So that's an interesting way to do it. Um, now, I see this quite a bit in Oakland, my new hometown. Um, and what folks did was they put all their money together. And this is one that I was saying can be challenging where everybody lives in the same place. But for a lot of folks, this is really the dream, right? The dream is to buy a, house or large condo together. Everyone live together. Maybe they have a common pastime, like they're all artists or they're all musicians, or they're, part of a particular community, and they really want to have a place where everyone can live together as a community. I will say this is for very close friends. I've seen this work best with friends slash coworkers, as opposed to family for some reason. But yeah, I have seen this work very, very well with friends and folks that are part of maybe an artist community or something. So that's one we see quite a bit. This one was a group in Portland. They decided that they wanted to balance home and investment. Again, they created a co-buy agreement, which we have talked about. Doesn't necessarily need to be drawn up by an attorney and notarized, but just to give a sense of, okay, well, this is kind of how we're feeling that this is going to go. Could be an email, could be a text chain, just so that we make sure we kind of check off all those items on the list so that we're thinking about it, right? And again, because the goal is to make sure that everybody is happy and content as we move through the situation. Again, I've seen this work best when we're talking about co-buying, either a situation where each party, so this is two parties, live in their own domicile, meaning a duplex, or a situation where you're talking about two homes on one lot. And one gets one home and one gets the other. Works great, right? Because people have their own space and it's easier to kind of divvy up, right? It's 50-50 unless there's some other, unique aspect that's coming, that comes later as far as, well, I'm a contractor, so I'm going to do all the home repair. Okay. So maybe that person gets a bit of a larger share. All ideas to work through. A much larger group decided that they wanted to do a co-buy. Let me move this out of the way so I can see. Um, we are seeing this again quite a bit more, where you're pooling your income to be able to apply together, right? And be able to be approved together for the property, right? So we're seeing this a ton, an absolute ton, where people are coming together. Again, whether it's a single family property, whether it's a duplex or a fourplex. Another great idea is a fourplex where the owners are going to live in two of the units and then they're going to rent out two. And then that becomes another item you want to add to your agreement is what happens to that rental income, right? Does it automatically go to the mortgage? Oftentimes when you have fourplex, two things can happen. Either one, the rental income will cover the mortgage, or two, you'll have some extra money, right? Quote unquote extra money, or it won't, right? And then you'll have a situation where everybody needs to contribute towards the mortgage for the time being until you can get those rents up to the point where there's the folks that are living there aren't actually paying to live in the property, right? Which is, of course, quite a dream scenario. So what happens in that situation? You're going to need to draw up contingencies for each of those situations. Maybe right now you need all four rents to cover the mortgage, but as time goes on, the mortgage will stay the same. That's the incredible part about owning property is that your housing costs are fixed for the next 30 years, right? So as everything else starts to get more expensive, that housing cost stays the same, which is why we want to get out of the rent trap because that's not what happens with rent. Rent continues to go up as well. So, what happens then when the rents become so high that nobody's having to pay anymore, right? Where does that money go? Is there extra money? Are we still contributing towards the fund, which you should be? The answer is yes. But how much are you contributing towards the maintenance fund, right? And again, you do have other expenses like the property tax and the insurance. So how do those things get paid? Again, just to kind of scratch some things out, talking about the way that things are now versus the way they are in the future will be really helpful so that you don't have a big headache when someone's like, okay, I'm ready to move out and buy my house. And then there's been no thought given to how they get their funds out, their share of the funds out, and what happens to the expenses. Or do they continue to own the property and maybe there's a refinance, right? And they take funds out, but they still own the property, right? And maybe they take funds out and one party gets half and one party gets the other half, right? So lots of interesting and fun things that can be done to creatively use this first purchase as a springboard to your next purchase. All right. Houses before spouses model. There's so many models out there. There's a lot of them, right? So these folks, young ladies, decided to purchase together as a co-buy. And I think I remember seeing a story about these folks on Instagram. And what they ended up doing was buying one house and then they bought another house and then they bought another house. I mean, obviously this would be very difficult to do in the San Francisco Bay Area because property is so expensive here. But it was smart, right? So instead of having a situation where they were, wasting money, unfortunately, renting is wasting money, on rent, they put that money towards property together, and then as a result, it worked so well they were able to buy the next house and the next house. And again, I've seen this work very well with friends because you're already simpatico as far as your personalities are concerned. It can really start to turn into a side business if you so desire. All right, so key lessons. Document everything. And don't be like controlled by that document. Realize that the document is going to grow and change over time, but it's really just a way to kind of get your thoughts out onto paper and say, okay, well, this is what I was thinking. Is that what you were thinking? It really aids with the communication. And then once you have something and some event happens, right? Another child, you get married, you get divorced, all these different things that affect your use of the property. You can then refer back to the document and say, okay, now I think this other strategy would work better. So it really gives you some sort of a document so that you can get what's in your mind out of your mind and in onto a piece of paper and in front of the person that you are people that you are uh, undertaking this great path with. And again, to path, the next word path. What is the exit strategy, right? What is the thought right now that you might be able to do? Is it going to be a buyout? Are you going to continue to own the property? What are the thoughts? What are the strategies around that? And again, this is another great opportunity for you to reach out to your realtor because we have seen a lot of different exit strategies. So it's good to be able to discuss these things as a group and brainstorm and see which suits you the best. And again, as I've been seeing over and over, communication and periodic review because it will absolutely change, right? Your thought process will change as you get into the property and you start using it and you're like, oh, geez, I thought I was going to be moving out sooner, but I sure do like it here, you know? And the person that you thought was going to be moving out soon isn't moving out. Or the person who never thought about moving out was like, wow, well, we've saved so much money. Now we want to you know, get the next property, right? And maybe they don't move out and they just buy another property, or they do move out and buy the next property. I've seen that quite a bit with duplexes as well. And then the remaining owner will rent out their unit. And but continue owning the property. So all of these things should be discussed so that everyone has a comfort level